but this is not unheard of, unknown territory. But the experience has been very mixed, and it's taken a long time, I think, for kind of a roadmap for how you do these things to be established. So the idea of this development facilities is to confront the hurdles. The hurdles are licensing, regulatory barriers, securing land titles and permits, concluding purchase agreements, and conducting environmental and social impact assessments, and finally reaching financial close. So there's a bundle of hurdles which need to be addressed by such a facility. And they need also, if possible, to improve transparency and protect public interest, i.e. to try to resolve issues related to unsolicited bids. There has to be greater transparency around those kind of occasions when this occurs. There's no one way of doing that. It's a process, and it would take time, but the expertise needs to be there to undertake that. And they need to crowd in, of course, lending by banks in the construction phase and institutional investors once projects are operational. And they, I guess, like all development finance, local expertise is crucial. And has also been proven to be important is to actually establish in-house technical, legal, and project management skills. So this is the agenda, and there's no quick solution to that, as I'm sure you can imagine. So going to the next slide. Yeah, there are different ways of financing can be involved, and this is just a snapshot of what might occur. Equity is obviously important. In some equity would have to be provided to reach financial close, and funding activities such as feasibility studies, all the things I spoke about, licensing, permitting, and project structuring, etc. So this would involve the facility, and some up to half of that kind of cost would be covered by the facility. The rest would have to be covered by the sponsors to the project, private sector. But it's proven invaluable that such funding, and it's highly risky funding, of course, to this phase of the process is not necessarily going to succeed. But without such funding being available, project development is very, very difficult. And the construction phase equity might also be needed after the project has finished, reached financial close, and during the construction phase. Then there also could be some corporate loans to fund later stages of the project development process, certainly to fund the construction phase, and to bridge loans to fund project improvements before long-term refinancing. That means to say that once the project is operational, there should be possibilities to refinance the equity invested by the project development facility, and also for the project development facility to reuse the funds which it had invested in this project. Hopefully there'll be more funds if it's successful to be reinvested than were invested initially, if everything goes well. So again, looking at this in the context of where these are some examples of project development facilities. The InfraCo in Africa and Asia are largely funded by the what would be FCDO today through an organization called PIDGE. And the other similar structures mentioned here are examples of where such efforts are also undertaken in a similar fashion. Again, the history of these development facilities has been, it's been a bumpy ride. It has taken much longer, I think, than they would have liked to kind of reach a proof of concept. And in some cases, it's been more successful than others. In fact, the InfraCo in Asia, which has invested across South Asia, East Asia, and of all places, has established a facility in Myanmar, and goodness knows what happened to that. But it was successful to start with. I wonder whether that's still the case. There are lots of risks here, of course. They have been more successful than those undertaken. The InfraCo in Asia has been more successful than the one in Africa, probably because of better capacity to implement overall capacity to implement such a complex structure as project development facility. In the next slide, I show an example of something we've been kind of experimenting with in Nigeria. Here, an institution called InfraCredit has actually been using a guarantee, actually provides a guarantee to brownfield projects. That means projects which are operational. And that guarantee has been very helpful in engaging with the pension fund industry, which is part of the financial system in Nigeria that actually functions quite well. So they are able to refinance these projects, the projects which are then, and issue bonds based on that refinancing with a guarantee provided by InfraCredit. That led to a situation where the challenge which I have been speaking about occurred, that there really was no funding for project development. So while they had the guarantee and they had the opportunities for refinancing the project, and the facility was so designed to attract pension funds, there was just nothing to invest in. So here we tried to develop the concept for a project development facility along with the phases which I mentioned, where donors would come in to begin with, would have a bigger say. And these donors, I suppose, could be DFIs as well. They're in the second phase here, but I think even DFIs might be hesitant in the first phase because of the risks involved in undertaking the first phases of project development. And in the second phase, then DFIs become involved with the implementation of the whole process. And finally, once the concept has been proven to work, then commercial parties, that means private sector parties, can start to invest in the same process. So this is a concept which hasn't been implemented yet, but which we have worked quite intensively upon during the past few years. So there's one here in the next slide of concept which is being implemented, and it's by an organization called Climate Investor. This is sponsored largely by FMO, the Dutch Development Bank. And you can see here the same kind of staging of involvement, which I've spoken about in the previous slides. This is all around renewable energy projects, so it's all around green finance. And in the first phase, the first stage, as it's called here, donor capital is used to fund the development fund, and with 50% loan and the development loan technical assistance. And that funds about 50% of development costs, where the rest is provided from project developers and other funds. And then it goes to a next phase where during construction, there's a first loss donor tranche, a subordinated debt tranche, and a senior tranche of funding, which again funds much of the actual construction, up to 75%. And again, I think the heavy reliance here actually on equity rather than debt, because debt can, of course, both be, it's good to have equity. If you can use equity, it's good because it's more flexible and you don't accumulate funding costs that way. And then finally, in the stage 3, the project is refinanced and institutional investors come in as well as DFIs. So this is an ongoing process, and it has led to a number of projects being launched. I won't say this is fully developed yet. It's still kind of experimental, but it is moving in that direction, so that the kind of process I described to you before, this is very much like a project development facility, is at work. On the next slide, some of the challenges which they have tried to resolve are mentioned. They've tried to address specific risks in each stage of the project life. identify and remove those friction points as fast as they can. They're blending finance using risk mitigation instruments as effectively as possible, and to reduce the time spent in accessing different types of financing. So they have the expertise, so to speak, in-house as to how to do this, rather than relearning the wheel with each new project. They will also be able to reuse their knowledge. They are trying to achieve scale by pooling portfolios of projects and attracting larger numbers of investors. They're trying to simplify the investment instruments as far as possible, which, as I say, greater reliance on equity, and reducing the cost of the financing somewhat by using less debt. And they are very proactive throughout the lifetime of each project. This isn't coming for nothing. The team is very large, considering what's going on already, and they have a pool of experts and in many different areas. And they acknowledge the challenge, I think, of establishing trust between donors, governments, and the private sector. And again, also they're trying to achieve momentum to recycle capital. This is a huge agenda, and it isn't one you solve easily. But it seems to me this is the way you're going to create the kind of assets we need to create in this space. And we need much, much, much more of it. And the next slide is slightly kind of a risk profile way of looking at this same discussion I've just had with you, so to speak. Obviously, for the risks are increase as you move from investing in fixed income assets to brownfield assets and greenfield assets. And it's at the top end of the risk profile that most of the risk mitigation, most of the effort really needs to be made, because once you get to the brownfield, that means to say a operational project, the risks are much reduced, and the availability of capital is therefore much easier. But clearly, there's a difference between investing in fixed income assets, as many pension funds do, and even in brownfield projects, but much less so than with greenfield development. So the challenge is therefore to move down this slope. And in the last slide, just so you don't think that this is simple, I've tried trying to describe for you what is actually involved in each phase of this development process. So on the left-hand side, you have the beginning of the project, project year minus one there, which is strange because that should be -2, I think. The developer equity. And then there are, of course, expenditures which mount as the project is developed. And once the developer has put money in year 0, the project development facility puts in some funds of its own in equity into the project, which is the high risk part of this, which would probably need to be financed from donor funds. And then once the financial close has been reached, various parties come in to finance the project's capital expenditures. Partly it's still developer equity, here subordinated debt and senior debt. And then once the project reaches the commercial operations phase, it's refinanced, and senior debt and subordinated debt are provided. And eventually, as the revenues of the project kind of increase, it's possible for the project development facility to exit its equity position, hopefully with a more in the way of funds than it used in the project development phase, so it can re-channel that equity into new projects. Anyhow, that was not a simple picture. I hope it was useful to the further discussion. So thank you very much indeed.
Thank you, Michael and Fiona, on that presentation. So we have we have a lot of questions actually outside here as well. And so before I ask my questions, I think we will address the questions and the Q&A. I think the first one is, will the slides be shared with the participants? Since those slides belong to Fiona and Michael, we'll need to ask them. Okay, we're okay. All right, fantastic then. But of course, we're not going to share it just as that, right? So we will share the presentations to you, provided you email to us a short paragraph on what you learned today or how it's going to impact your organization. So at least we get some results from this entire webinar. So essentially, if you want the presentations, email to us. I will put up the email address in the chat box. Email to us with a short paragraph of what you learned today and how it will impact either your work or your organization. So in that manner, then we will share the presentation. I think that's fair, isn't it, Fiona and Michael? Fantastic. So going back to the Q&A, we have Said Hissam Alwi Said Ibrahim. He is asking, what is the preferable funding, debt or equity in most of the projects? So would Fiona or Michael, what is the preferable funding, debt or equity in most of the projects?
Well, I can answer that, unless Fiona would like to. Obviously, for most of these projects, they would prefer equity funding because they don't have to pay funding costs on that. They only have to pay at the end of the project cycle, hopefully, a return on equity, and that is a less of a commitment. So there's going to be a trade-off here because if again there is not, equity is more scarce compared to debt, and so you're going to try to use debt wherever it's possible and appropriate. I'd say to that, because if it's funded by equity, life will become very easy. As I said, Climate Investor, which I mentioned during the presentation, has experience of having tried this in some developing economies in Africa, and had so much experience that they felt, I think, having tried this for many years, that it made life too difficult for them to actually go through this project development process. So they would largely rely on equity if they could. But even in their diagram, which I showed you, they were not suggesting that debt is not there. Debt is there as well.
Okay, so we have another question. Is there any key lessons in lowering or mitigating risks for DFIs, especially if you have any experience or at least some key lessons in that term?
So I have a few ideas and I'll pass on to Michael. I would say, we talk about PPPs, I would say 3 Ps. One would be preparation, partnership, and what the third one was going to say? Preparation, partnership, and pooling. That's right. So preparation, a lot of what we do and a lot of what our PPP and infrastructure and climate financing teams do is try to standardize. So the more that you can have standardized contracts in projects, the lower the risk, because everything is known, it's on a sort of international basis, it's easier to compare. Development banks and other commercial banks can be more familiar with the type of contracting and PPP structures and infrastructure, renewable energy, etc. So the more that you can prepare, the more that you can do stuff on a standardized basis. That's one way to reduce risk. 2 is partnerships. So a lot of what we do is try and work with local institutions and then very experienced international institutions. So on the development bank side, one good example is some work we were doing in Colombia, where the IFC, a sister organization, who's obviously a very experienced DFI in infrastructure investing, worked with a new setup of a local development bank. And they partnered together to then invest, along with institutional investors from the country, in road projects. So it's an example of, I think, of partnerships. So locals with knowledge of the local context but maybe less knowledge of the sector can work with international investors. And I think that's a good way of partnerships of lowering risk. And then finally, obviously pooling. The more that you can pool projects and invest on a sort of fund basis rather than a one-by-one project basis, obviously another way of diversifying risk. So those are some PPP ideas, I would say, for reducing risks.
Michael, would you like to add anything to that?
Yeah, well, I agree with what Fiona said. I think that one of the biggest risks that that there is in this kind of space is government risk. So management, you can't manage government risk, but you can maybe reduce government risk as well. You can mitigate government risk. So given what I was talking about was very much starting from trying to generate capacity, trying to generate momentum. Maybe you don't want to go for the big projects. That's why the renewable energy projects, which I mentioned in Climate Investor, are generally not that big. They're compared to a power plant, it's nothing. It's very, very small. And the limited visibility of the project may actually be an advantage to reducing that kind of risk.
Right.
So go with either with a local government, you don't have to go with the federal government or whatever. And I think what Fiona mentioned about partnerships is important also it's really a governance issue. Again, because the influence of local partners or the compromises which may be imposed on DFIs, and I think that's probably true in every country, can be reduced if you can bring in some foreign partner, like the IFC in the case that Fiona mentioned, but it doesn't really matter which foreign partner it is. They can provide stability in the governance, the new institution or the facility or whatever it is you're trying to establish. So I think that is one of the reasons why, when I mentioned the facilities I gave examples of, they weren't the local facility established in country X, partly because of capacity issues, but also partly because that it is quite difficult to do that and remain kind of in control of what's going on, independent and manage the process.
I can imagine. Okay, we have another question. How has been the take-up rate or subscription or over-subscription rates in the recent issuance? I guess with the current pandemic going on and whatnot, the take-up of this financings within the last perhaps year or year and a half.
Well, since we're on the sort of sustainable finance side, so there is a huge appetite for sustainable bonds, green bonds, etc. at the moment. There is a lot of appetite for these instruments. So what we've seen is generally, I would say globally, I don't have the statistics at the tips of my fingers, but someone like the Climate Bond Initiative has very good data. But generally, they've been very oversubscribed, a lot of the green bond issuances. And what we've seen is very interesting that sometimes you've seen investors buy green bonds in a country or a sector that they wouldn't necessarily go to with a vanilla bond. So I was talking to, for example, the bank in South Africa that did the first green bond in South Africa, and they had investors who've never invested in South Africa, never invested in Rand, would never have bought their corporate bonds, but they bought the green bond. So there's a lot of demand, I think, there. Now, there's not a lot of pricing differential yet. This question of a greenium we could get into all night, but not much pricing differential. But in terms of new types of investors who are prepared to come into new sectors and countries, there's been a lot of appetite. I think things like the COVID bonds, the ones I mentioned in Europe, were very oversubscribed. So very positive response, I think, for this wave of, as I said, I started with the wave of sustainable financing, the wave of intention. Investors are looking for these sorts of opportunities if they're well structured, etc.
Thank you. And there's another question here. Is there any if they're asking if the panelists can share if there is any hesitancy from potential borrowers or investees when it comes to equity financing, how to educate borrowers to overcome hesitancy, if any, if you've come across this. Fiona or Michael?
Michael, have you seen anything on that side?
I don't have much information on that either to go with, no.
Okay, that's okay. So there's another question here in the Q&A box. Which is better in terms of financing initiative? Is it towards the producer or the user? When you see across, is that relevant though?
Yeah, well, I've been talking mostly about term financing of the producer rather than the user.
Mm-hmm.
We're talking about trying to make it easier to bring investments to market, so to speak. And it's, in that context, it's the producer that needs the term financing. Mm. The user is going to be committing to a payment over a long period of time. And that, again, it refers to largely when you get to the user, we've gone through the development phase, we've gone through the construction phase, and we're actually having an operational project before the user gets involved. So I think that's a headache, and then the user will be involved in repaying whatever the utility, the cost of the renewable energy is over a period of time. So it's giving the user the opportunity actually to benefit from the project structure. You have to find a means of financing it so that it isn't overly, it isn't prohibitively expensive to the user.
Right.
That's the whole of the purpose.
Understood. Okay, so this is here you mentioned earlier on the government risk, Michael. I think this question relates to that. The question here asks, what is the role of government to support initiatives made by DFIs to be successful? I think, relating to your government risk earlier in terms of, how much is the government going to support, or at least, can DFIs rely on the government to their support? I think the exposure is very varied in terms of governance of each government. But I think that is a question perhaps you could answer as well.
Well, I think it is very dependent on each government, and each government is going to be different to deal with. So I can't speak kind of generally about that. I don't know. The Malaysian government may be more awake and aware of the risks involved here, because without that kind of endorsement of the kind of process we're talking about, if we're going to actually invest in this space, and a process by which the government facilitates and is fairly hands-off in its approach to how the development finance institution makes decisions, it's going to be very, very difficult to implement anything. And there's lots of experience of what happens when that's not the case. Yes, that is a crucial element of this discussion. And I guess it's crucial here just because of where I started by talking, which is that if the government thinks it's going to manage the investment itself, it's probably running a huge illusion, because the needs are so enormous. Mm-hmm. And so unless the government is not just a regulatory, it's not just involved in regulation here or oversight, it has to establish a framework where the private sector will engage. And I think that pilots or projects, efforts undertaken in the first phase of kind of this development process will be proof of concept, much of which will be relating to what is the government contributing, how is the government supporting this process, and also, of course, how is the DFI or whoever's investing in this process, how is the governance of that institution working, and can we rely on this as a steady hand in making progress? So that it is just so crucial. Yes.
Mm-hmm. Okay, so I have one question. This is from myself. So you mentioned about different types of projects, and you mentioned about how projects are actually funded and whatnot, and the different tools used for those projects. Now, my question is very a little bit more specific in terms of there's this huge debate in terms of, investing in oil and gas as well as investing in agriculture. There's a debate between, look, agriculture is more carbon, like there's a lot more emissions coming from agriculture as opposed to more emissions coming from oil and gas and back and forth. So how does, a few questions coming from this is that, have you come across anywhere in the world where they actually put in clauses within the financing contract where they say, hey, look, you need to reduce this amount of emissions in your projects, or before you give out financing? Or is there, you're considered as counterproductive if you're actually financing more of oil and gas or agriculture? It's just a question out there. Michael or Fiona?
So rather than sector specific, I would say, I'm sure the people on the call, but certainly at the bank, all the projects that we do now have a resilience component in them. So all the projects that we finance now have to consider climate and the impact going forward. Everything we do, all the infrastructure projects that we do. And I think this is an opportunity, for a lot of developing countries. You think of my country in the UK, and Michael will know there was huge floods in London in the last few weeks, and the very old sewer systems couldn't cope with the amount of rain. Whereas we're trying to build forward in the emerging markets and in the countries that we work in to make sure that they are resilient. So the type of infrastructure that we're putting in place is adaptable and will be able to cope with the climate changes that are coming. So we're building that into a lot of our projects. And then I think also that's also then a role for the development banks to think about how do you judge the impact, as Michael was saying, of the projects that you're financing. And there are increasingly impact measurements. The governor mentioned some sector-specific ones for Malaysia to really think about the impacts going forward. So I think that rather than and some of those can be sector-based. Yeah. I'm sure there are very good standards for agriculture as a sector as well. It's not a sector I know very well. But I think really trying to think about these factors and build forward is very important and is an opportunity, I think, for many of the countries that we're working in.
Fantastic. Thank you. Well, that brings us to the okay, so there's a question for the moderator. I think that question we'll answer a little bit later. Anyway, that brings us to a session, to the end of the session for this morning with World Bank. And I would like to sincerely, extend our appreciation to Ms. Fiona and Mr. Michael Fuchs, who spent their night with us today. And as you may already know, the difference in time zones, and we really do appreciate the commitment and their sharing for this session today. And we thank you, Ms. Fiona and Ms. Michael, for that sharing session. We will take a 10-minute break because we don't want everyone to have a screen fatigue, right? So there will be videos playing while the participants can take a 10-minute break for restrooms or resting or even to get your breakfast, right? So in the meantime, thank you. Fiona, thank you, Michael. Appreciate it very much. Have a good night. You're welcome to stay until, I think it'll be 4 p.m. today, but it'll be 4 a.m. there. So I'll invite you to stay anyway. Thank you. Thank you very much, Fiona and Michael. Appreciate it.
Thank you for hosting.
And we will, for the participants who are here, we will be here till, we will start again at 11 a.m. with Diana Smallridge from CENDB. So 10 minutes break for everyone, and we will see you in a couple of minutes. Thank you. In 10 minutes. See you.
always have a support structure that you can rely on, having people that can always deliver, and at the very least, those that can show progress on a daily basis.
Kita adalah brand holder. Kita kena yakin dengan brand kita. So sebelum kita nak meyakinkan orang dengan brand kita kena yakinkan diri kita dahulu. So macam mana? Ilmu, knowledge. Pergi belajar. Tak belajar, tak tahu. Saya buka syarikat saya sendiri sebab masa itu saya yakin masyarakat tak boleh bergerak tanpa motivasi.
புதுசாக வித்தியாசமாக நீங்கள் யோசித்து ஒரு மார்க்கெட்டில் டிமாண்டாக இருக்கிற ப்ராடக்ட்டை நீங்கள் கொண்டு வந்தீங்கன்னா பயனராகவும் ஆகலாம். அதே சமயத்தில் மக்கள் திருப்பி வந்து உங்கள்கிட்ட வாங்கிட்டு இருப்பாங்க.
把你的生意放上网络平台，我朋友是做网络卖衣服的生意，他的生意是不断的在增长。我起步的时候是跟去银行贷款，所以他说我的规模也是太小，所以他是不接受我的贷款的。有一天我上网寻找贷款，然后过后就找到 IMSME， 过后我去 click 进去申请表格。第二天 CGC 的有一个顾问打来跟我说，你可以尝试用 P2P 的平台，过后就成功了。
The great thing about this whole CGC ISME program is that it's no collateral and you can go for as little as 1,000 ringgit to as much as 5 million. I went online and went to the page, registered, logged in and just keyed in my details, and from there within a matter of days things were already set in motion. So it's really that straightforward and that simple. I was able to get it within a matter of weeks. I think everyone can too.
IMSME ஃபண்ட் வந்து நாங்கள் வந்து அப்ளை பண்ணியிருந்தோம், எங்களுக்கு கிடச்சிச்சு. அது மூலிமா எங்கள் பிஸ்னஸையும் வந்து எக்ஸ்பேண்ட் பண்ணோம். 10% வந்து இன்க்ரீஸ் பண்ணோம் எங்கள் சேல்ஸை. இது மூலிமா IMSME ஃபண்ட் வந்து ரொம்ப உதவியாக இருந்துச்சு எங்களுக்கு.
Sebenarnya dalam business, fun is everything. You have fun, you can go bigger. You don't have fun, you cannot go anywhere. CGC banyak membantu saya untuk saya go and move further sebenarnya. Dan at the end, saya dah ada branch baru dekat Alustah selepas saya dapat dana daripada CGC. I have no fun problem at all after that. Jadi dengan IMSME memang banyak sangat ubah hidup saya dan banyak membantu mengembangkan bisnes saya.
感谢 IMSME 帮我的生意更上一层楼。
always have a support structure that you can rely on, having people that can always deliver, and at the very least, those that can show progress on a daily basis.
Kita adalah brand holder. Kita kena yakin dengan brand kita. So sebelum kita nak meyakinkan orang dengan brand kita kena yakinkan diri kita dahulu. So macam mana? Ilmu, knowledge. Pergi belajar. Tak belajar, tak tahu. Saya buka syarikat saya sendiri sebab masa itu saya yakin masyarakat tak boleh bergerak tanpa motivasi.
புதுசாக வித்தியாசமாக நீங்கள் யோசித்து ஒரு மார்க்கெட்டில் டிமாண்டாக இருக்கிற ப்ராடக்ட்டை நீங்கள் கொண்டு வந்தீங்கன்னா பயணியராகவும் ஆகலாம். அதே சமயத்தில் மக்கள் திருப்பி வந்து உங்கள்கிட்ட வாங்கிட்டு இருப்பாங்க.
把你的生意放上网络平台。我朋友是做网络卖衣服的生意，他的生意是不断的在增长。我起步的时候是跟去银行贷款，所以他说我的规模也是太小，所以他是不接受我的贷款的。有一天我上网寻找贷款，等下过后就找到 IMSME， 过后我去 click 进去申请表格。第二天 CGC 的有一个顾问打来跟我说，你可以尝试用 P2P 的平台，过后就成功了。
The great thing about this whole CGC ISME program is that it's no collateral and you can grow for as little as 1,000 ringgit to as much as 5 million. I went online and went to the page, registered, logged in, and just keyed in my details. And from there, within a matter of days, things were already set in motion. So it's really that straightforward and that simple. I was able to get it within a matter of weeks. I think everyone can too.
IMSME ஃபண்ட் வந்து நாங்கள் வந்து அப்ளை பண்ணியிருந்தோம். எங்களுக்கு கிடச்சிச்சு. அது மூலிமா எங்கள் பிஸ்னஸையும் வந்து எக்ஸ்பேண்ட் பண்ணோம். 10% வந்து இன்க்ரீஸ் பண்ணோம் எங்கள் சேல்ஸை. இது மூலிமா IMSME ஃபண்ட் வந்து ரொம்ப உதவியாக இருந்துச்சு எங்களுக்கு.
Sebenarnya dalam business, fun is everything. You have fun, you can go bigger. You don't have fun, you cannot go anywhere. CGC banyak membantu saya untuk saya go and move further sebenarnya. Dan at the end, saya dah ada branch baru dekat Alustah selepas saya dapat dana daripada CGC. I have no fun problem at all after that. Jadi dengan IMSME memang banyak sangat ubah hidup saya dan banyak membantu mengembangkan bisnes saya.
感谢 IMSME 帮我的生意更上一层楼。
We still have 360 people online, and we also have this on live Facebook as well. We have tons of people there. We have it on live YouTube as well. It's our first time going on YouTube as well. Again, we would like to appreciate Michael Fuchs and Fiona Stewart for coming in and having a sharing session with us. And again, a little bit later today, I will, in order for us to share the slides from this morning, and we will require you to email to us a little bit of your sharing in terms of what you have learned as well as how it's going to impact your organization. I think that would be a fair exchange between us. So moving on, the Center of Excellence for National Development Bank, CENDB, was established to address the urgent need for a centralized global knowledge hub for NDBs. The CENDB serves as an online nerve center for gathering and disseminating innovative solutions and best practices. CENDB offers a range of holistic, practical, hands-on capacity building programs that help lift individuals and organizations to meet their full potential. And ADFIM is very much looking forward to working with CENDB in the future to build our capacity here in Malaysia. Diana Smallridge is our speaker today, and she is widely recognized as one of the foremost advisors and pace setters in the field of development finance and global trade and investment. She is president and CEO of International Financial Consulting Limited, a firm she founded in 2000 that offers customized solutions and expert advisory services to public financial institutions and governments worldwide. Diana has consolidated a high caliber team of global professionals and successfully overseen the execution of over 250 projects in 65 countries. Diana's in-depth global expertise has elevated her reputation as a published author and prominent specialist in the field. She is known for being a trailblazing thought leader on current issues such as blended finance and climate finance. Diana is a sought-after speaker and facilitator for workshops and conferences internationally. She has been the chairperson for XCRED International conference for over 20 years. And in 2019, Diana was selected as an inspirational women in finance by Trade Finance Global magazine. So we hope she will inspire us today as well. So Diana has authored numerous publications on the role of national development banks and international trade and investment, and is a leading expert in development and export finance system and their role as catalysts of economic growth. Diana is also the creator of Full Potential, that's copyrighted, strategic planning methodology, as well as health diagnostic tool, products deployed by development institutions around the world to measure and improve organizational performance. Diana graduated from Queen's University in Kingston, Ontario, with a Masters of Arts in Economics. She worked with the Export Development Canada for 12 years, where she was Director International Relations as well as Special Advisor to the President. She departed in 2000 upon founding International Financial Consulting Limited. So we welcome Diana to the stage. Welcome, Diana.
Thank you very much. Assalamu alaikum. It's wonderful to be with you all this morning. It's evening where I am. I'm based in Vancouver, so I'm not suffering to the same extent our World Bank colleagues would have, who are 3 hours ahead, and it was well into their night. It's still a reasonable hour, which is why you see some light around me. It's a great pleasure to be with you and to share some views, experiences we've had working with national development banks globally. That was a rather fulsome introduction, Prasad. I'm very grateful for that. But we come to you with these experiences working with national development banks from every part of the world, and every type of national development bank, as you well know, and the membership in ADFIM is certainly testimony to the types and varieties of national development banks with their different mandates and approaches. And so what I want to share with you today, and as I share my screen, I will be focusing on, let me get this to you so you don't have to, and I'll put it in, yes. So what I'll be sharing with you is the role of national DFIs, development banks, in financing the SDGs. As I say, and you know well, there's no one type of national development bank, be it infrastructure, be it SME focused, be it trade focused, like an Exim Bank. But some of the similar ideas and processes are quite relevant. I'm coming to you today not only as the president and CEO of International Financial Consulting, but also the new founder of the Center of Excellence for National Development Banks. I want to talk to you then, give a brief introduction, talk about financing SDGs, and then what that means in terms of measuring development impact, sustainable development monitoring systems that are deeply embedded in a very intentional results chain and theory of change, leading to the enhanced balanced scorecard. And then I want to give you a few takeaways and then open up to Q&A. You don't need to know about me. You've heard way too much already. So let me tell you about the Center of Excellence for National Development Banks, CENDB. It was founded in 2021. And really the idea here is that we've often noted that national development banks are the unsung heroes of the development world, and they're critically needed to support the SDG achievements and the role of national development banks in Paris Agreement. But certainly what's critical is that they're not well understood, often at the government level, and what their capacity is. And so we were finding that the lessons learned from let's say a BPMB in Malaysia could so work and be valued by Banobras in Mexico, the national development bank that focuses on infrastructure. And so the idea really is to find this twinning concept and bring together national development banks who share similar challenges. So bringing in capacity building programs that are really tailored to the unique context of development banks, and particularly those elements of NDBs that make them unique. The governance structures, the alignment to government priorities, etc. And then the lack of connectivity and knowledge exchange, we see that as a really important priority. So the mission is really to have NDBs fulfill their development mandates and reach their full potential through this knowledge exchange, with the vision that our consulting company carries is better institutions, better outcomes. Well, I won't go into this because I think in the interest of time, but we're really looking, and we've piloted it and found that bringing together a cohort of specifically focused individuals who have the same challenges, work in a similar role, and can come together, forging these micro networks, creating a very dynamic context and very interactive with tailored content. So we've developed 2 courses, and we've held 2 courses around smart SME lending, an important one also around building a constructive relationship with your government or your shareholder oversight body, which again, that's a critical piece for a national development bank. And I know the assistant governor of the Central Bank of Malaysia has been a very big supporter of ADFIM and your DFIs, national development banks within Malaysia. And so it is critical that these relationships are well forged and they have a constructive relationship. We've got a few programs under development, such as how to measure development impact, and I'm giving you a taste of that today. Fiona very kindly mentioned the report on a guidebook on climate risk for national development banks. In fact, I was really delighted because we authored that for Inter-American Development Bank. And I'll make sure, Prasad, you have that link so you can share it with the many people in the room, I think, who will find that really helpful. And then we do bespoke training courses, whether it's product training or specific training at the request of a single DFI. So let me get to the substance of our discussion. Financing the SDGs, a very familiar graph. Everybody knows Sustainable Development Goals, the 17. I think the challenge or the question is, how do DFIs relate to these? What can a national development bank do to contribute to the no poverty goal, the zero hunger goal, the good health and well-being goal, quality education, gender equality, clean water, affordable energy, et cetera, partnerships, number 17, peace and justice. Accepting these as the goals, which they are, then finding where the links can be for your organization. As I said, not all DFIs are going to have an industry and innovation and infrastructure focus. If they're an SME focused bank, they may be looking at gender equality as being a key development impact indicator. Obviously, climate action, and we've heard about this, how important climate action, number 13, and number 7, affordable and clean energy are, because that really resonates with the Paris Agreement. So these are critical points at which the DFI needs to hook themselves to. So to achieve the SDGs, as outlined in the 2030 Agenda, it's going to require, as we heard earlier today, massive investment. And that massive investment needs to bring the public and private sectors together at scale. And it's not just about money, it's about looking at what are the financing gaps and how to adjust the systems in order to really drive private sector and catalyze private sector financing. And so it means reorienting how these public and private actors interact with each other and really look at the key dimensions of sustainable development. In my mind, national development banks sit at the nexus of all the main parties involved in in financing the Sustainable Development Goals. They're playing a critical role within the country's economic ecosystem. They obviously have a role vis-a-vis their government ministry and related to their oversight body. They have a role with local financial institutions, particularly if they're a tier 2 lender, a direct lender, co-financing with financial institutions. But the local financial system is critical. Local companies, obviously, are critical stakeholders, project sponsors, international development agencies, climate funds, and the private capital market. So they sit at the nexus of all these players. There is no other institution within a country that really has that kind of reach. And as Fiona talked about, the role is filling market gaps to these underserved markets. And of course, the assistant governor also spoke about this, mobilizing capital, as I've mentioned, in private, catalyzing private finance, and that counter-cyclical role they have to play, and certainly the role they're playing today in COVID relief. Encouraging innovation, enhancing financial inclusion, and promoting environmental sustainability. I loved what he said about the nudge, because I think, as I'll discuss in a moment, no other government body has the capacity to make that nudge in such a positive way. So looking at how to measure development impact, and I want to spend a bit of time on this because this is really the crux of the topic. It goes without saying that a DFI must balance financial return with development return. That's a notion that we understand, but what does development return actually mean, and how do you measure it? It's critical, obviously, to have a bank that's financially sustainable. A lot of debate whether it is not just financially sustainable, but profit-seeking. But that cannot be at the expense of achieving a development return. And so we're going to be speaking this morning about what does the development return look like and how can it be measured. So for a moment, let's just define development impact, sustainable development impact, quoting from the Brundtland report some years ago, that sustainable development is the development that meets the needs of the present without compromising the ability of future generations to meet their own needs. So it has these three components, the triple bottom line: environment, economic, and social. And those are fundamental as you go in as a national development bank to thinking about what kind of impact are we having on society as a whole. Fundamental in driving development impact, sustainable impact, is finding that link with the national development goals. Countries have national development plans. I know Malaysia has a very in-depth and thoughtful plan, and a number of sector plans as well. There's also the NDCs out of the Paris Climate Agreement that speak to specific initiatives of how climate mitigation and adaptation can be undertaken. So these speak to these external drivers: the Paris Climate Agreement that the government will have signed on to, the Sustainable Development Goals the government has signed on to, and these SDGs and the financing of these SDGs then is the big question. We're working right now with the government of Nigeria. The UN has now adopted this concept of an integrated national financing framework that says, okay, this is the cost of funding these sustainable development goals. How are we going to do it? And so we're developing for them a broad-based strategy. And I think this is a critical component because, needless to say, you've got goals, but if you don't have a plan to meet the goals and finance those goals, you're going to be in trouble. In terms of some of the internal drivers, there was mention, I think it might have been Michael who spoke about having an institutional charter or a mandate that really says, yes, this is what our organization is about. This is what this DFI is about. It's about alignment to the National Development Goals or the National Development Plan. It's about contributing to the achievement of the SDGs and the Paris Agreement. Out of the charter then is having a vision and mission statements that are aligned to that. And Prasad kindly mentioned our strategic planning work. We work with development banks around the world to align the vision and mission to all of these aspirations. And then a corporate plan, an annual plan that really then speaks to the implementation of these actions. So why measure development impact, sustainable development impact? It's about being in alignment with the institution's vision, mission, and strategy. And as I'll discuss in a minute, it's so fundamental to have that central. I think Fiona mentioned one of the organizations they're working with, the Development Finance Corporation of Belize in Central America, that has decided to embed climate across their institutions. They mainstream climate against everything they do. That is, by the way, consistent as well, thinking about climate not just as an opportunity for a national development bank, but also the climate risks and the need for assessing resilience. Measuring development impact demonstrates contribution to the national goals. And so, as I noted, that's really critical. If you're owned by government, if you're a government-backed, government-sponsored entity, it's really important to align your contributions and be able to say, we've done this towards, we've helped contribute to these number of jobs being created. It shows the extent to which any observable socioeconomic environmental changes can be attributed to the commercial activities of the development bank, demonstrates relevance of the institution to beneficiaries, and beneficiaries are the broadest category of stakeholders. They can be ultimate clients or small businesses who might access intermediated funds, that may be users of infrastructure. But as a government-owned entity, you're being watched. You're being noticed by the taxpayer as to whether you're really contributing. It enhances the credibility of the institution, not just with these beneficiaries, but also international financiers. More and more, the likes of the World Bank and EIB and Asian Development Bank, et cetera, are requiring the institutions to be able to demonstrate this, to give clear reporting on the development impact. And so increasing external financing, and particularly we were just discussing about access to the green bond market, social bond market. That's a really critical piece of the puzzle to be able to broaden the access to finance. So what does it mean for a DFI to be SDG aligned? We've developed a model to think about, and for those DFIs who are on this call, to think about where you might be. A non-existent DFI is one where you might have some notion of what an SDG is, but you've never really linked it to your activities. You have no framework. None of your activities are related to SDGs. You're not collecting any impact data, obviously no reporting. And to be blunt, you really don't know what you're doing, so you don't really have internal capacity. I think that's fair to say. The majority of DFIs 5 years ago, 10 years ago, were probably more in that camp. A mature DFI, and I'll say from my perspective, there are very few globally, have a documented SDG alignment framework. SDGs, the 17, are considered across all stages of the project cycle for all transactions. So whether it's an SME, you're thinking about SDGs at the credit approval process, you're thinking about SDGs at the portfolio management process, you're collecting ex-ante data, pre-disbursement, pre-intervention, and ex-post data to confirm that what was announced, what was expected in the pre-loan stage did actually happen. We've had clients who couldn't call themselves mature, who were reporting on jobs created, but basically they were ex ante calculations. And we had to say, you need to be very careful to be reporting in these public documents that you created X hundreds of thousands of jobs when that's just what a client was going to tell you and hope for. Specific and consistent SDG reporting, in fact, having a sustainable development impact report that you produce annually alongside of your annual report, and a full internal capacity. And so clearly that's a mature stage. There's nascent, intermediate, advanced, and mature. And so we've been working to help institutions move their way up the maturity ladder to be fully engaged in SDG alignment. So giving a snapshot of what a sustainability framework might look like. You've got here the commitments you've made to sustainable development, whatever that might mean. But as I noted, it's financial return, development return. So the development return speaks about your contribution to national development goals, SDGs, and the Paris Agreement. This will be facilitated by the procedures. So it's all very well to have these commitments and they're stated in a nice policy wording, but it's around, obviously, the financial return is your risk management, asset management, financial oversight, et cetera. But development return is ensuring environmental, social protection and taking account of climate risk. And then your sustainable development impact monitoring. So procedures around how that can be done. And many of you will be very familiar and likely fully engaged in doing environmental and social risk management at the point at which the projects are being assessed for a credit decision. There's an ESG component. What we're talking about here is having a sustainable development component at the same level of review. These are guided by policies, ESMS policy, and sustainable development impact monitoring policy, which would then feed into these reports where you're measuring results and accountability. So let's just look at what a sustainable development monitoring system could look like. So it allows an institution to credibly measure and report sustainable development impact of their bank's work. And I want to underscore the word credibly. Back to my small vignette about a client who was basically taking the word from clients and then adding them up and saying, this is how many jobs we're creating. That's a bit of a dangerous game to play. And so it's really important to build a credible measurement system with extrapolation, yes, but validation and verification ex post. So a system needs to include a policy framework, to my point in the last slide, and then very clearly defined sustainable development outcomes that are related to the bank's activities. And they're going to be different if you're an infrastructure bank or if you're an SME bank or if you're an Exim bank. And then indicators and the tools and protocols for measuring these outcomes. So the key elements of a monitoring system would be the policy statement, and this is at the level of governance of the board saying, this is what we're committed to. And I can't overstate the importance of a board mandated and declared statement. It's not just a nice to have, but it's really necessary to align the organization right the way through. Defining contributions to SDGs, and so a clear, thoughtful analysis of where the products that you offer, where in the sectors that you offer, link and the government's focus that they give you in terms of, it may be a focus around economic diversification away from fossil fuels. It might be a focus on building more inclusive and gender equity. So whatever you get from government, and then you focus on the contribution to SDGs. then building a results chain and theory of change. And this is the distinction that a national development bank has compared to any financial institution, except impact investors. It's really thinking intentionally about what it is you're trying to achieve. Defining your development outcomes, building a log frame that is consistent with this, and then having the tools to and processes to measure impact. So I mentioned about the policy statement. It really sets the tone for the level of commitment from the bank, from the leadership through to operations around sustainability. And it really needs to be something that internally people can align to, so the staff and management, but also the world at large who are looking and need to see this as your commitment. It's a brave move, but it's really important to have this policy statement. And it speaks to the commitment you're making to these broad goals, SDGs, Paris, et cetera, and commitment to measuring the impact. So the policy statement is critical. Moving now to the question of the results chain and theory of change. And I'll state this quite simply. If you are a commercial bank, you're thinking about how much can we take our dollars and our human resources and transform that into loans and financial services and make a profit. I'm simplifying, of course, but it's input-output. What we're talking about in this concept is an input-output outcome and impact. It's this full results chain. So inputs, whether it's HR, dollars, whatever, facilitate your activities, which then deliver outputs, which then are utilized to achieve outcomes. And this is where we start thinking about development outcomes, which contribute to development impact. Now, it's pretty easy to measure, how much staff and how much capital you're using to generate activities and outputs. But attribution becomes very difficult and more difficult, let's say, as you move up the results chain, because you lose control over the results. You may have loans here in your outputs, number of loans, but can you control how those loans are put to use and how many jobs? This was the whole point I was making about jobs created. How many jobs will be created as an outcome? And then how much can those jobs created really contribute to the overall development impact? So recognizing the attribution point is a challenge. But the time for evidence, you can see the evidence right away on inputs to outputs, but over time, it takes a while to see impact. It takes a while to be able to see how your activities and your outputs have contributed to a changed world. So thinking about the kind of indicators, here, output indicators are highlighting deliverables obtained from your activities or inputs. So number of loans, number of new clients, it's kind of the standard set of indicators any financial institution would have. But outcome indicators are showing the direct outcome of the deliverables on clients and countries. And then impact indicators is showing the bank's contribution to the achievement of the high-level results. And this is where it gets trickier because of the attribution challenges. Now, I want to mention additionality. The assistant governor mentioned additionality, and I think it's a really important point to understand from your perspective, our perspective as an industry. What does additionality mean? When you are filling a market gap, you are seeking to crowd in private sector sources of capital, trying to avoid crowding out. The world needs more crowding in. Crowding out is dangerous. what will that look like? It looks like a financial additionality where those project outcomes are likely not to have been achieved without your involvement. Non-financial additionality is you actually made the project more sustainable, richer development outcomes. You had an influence, maybe in the environmental and social risk domain, to make that project a better project from a sustainable development perspective. And risk reduction, your bank's participation reduced the project's risk through your reputation and created a demonstration effect. So I want to give an illustration of what could be a theory of change that's developed from the results chain. And I want to talk about the intentionality behind this. So this is picking up sort of a generic kind of institution, DFI, which has capital and human resources. But what does it hope to achieve? Yes, the outputs are the loans, SME loans, or infrastructure loans, or it might loan guarantees, or sovereign loans, or whatever, trade finance instruments, any raft of outputs that you would normally be measuring. But let's think about the outcomes. The outcomes: improved access to finance, better business performance of your borrowers, increased employment, which is a classic one, increased access to social and economic infrastructure, improved sector performance. This might be something that if you have a mandate or a government objective to diversify, this could be quite interesting. Increased trade. And so then taking these outcomes, thinking about what it is you hope to achieve, moving to then what kind of sustainable development impacts might it be? Might be seeing, GDP improving, GDP per capita improving, tax revenues, and then aligning to some SDGs. Yes, this relates to good work opportunities or social infrastructure or partnerships or whatnot. Well, social, you might say, because of the increase in employment, we're raising people out of poverty. Environmental, obviously, are critical. So then we look at these broader impacts that really speak to your vision about increase in prosperity and GDP for the country, economic development. So defining these development outcomes takes some work, takes some brainstorming, blue sky, but putting yourself in this results framework with a theory of change. Again, this is illustrative of the kinds of outcomes you might be looking for. Now, I want to then position this in the context of, I'm sure you've all heard the balanced scorecard, and that's a classic, very classic way of measuring performance. The enhanced balanced scorecard is something that a concept we coined around a fifth dimension. So the classic, Kaplan was the developer of it, financial customer internal process learning and growth. So we've been talking about adding that fifth perspective, which is development impact, and it's all part of the same scorecard, but you've got key developmental KPIs that look at the outcomes with the outputs in a single perspective. So an example might be you've got the four classic perspectives, and then you have the development impact. And I've just given you a few ideas of increased access to finance, increased employment. So these are a few ideas that could be relevant in terms of measurement of specific indicators. If you blow this out a bit further on the development impact perspective, talking about some of these being output, value of loans finance, fine, value of interest subsidies, if that exists, then start thinking about how the beneficiary firms were enhanced, number of jobs created. Then if you're talking about economic and social infrastructure, the square meters of road or kilometers of new road, square meters of a hospital, or number of new hospital beds, or whatever that might be. Then you get into potentially the whole climate area of avoided CO2 emissions, or megawatts of renewable energy. And then increased trade, there may be one there. So each DFI is going to have a different set of development outcomes they're seeking, and therefore strategic objectives and performance measurements that will be dependent on the kind of business model. So let me now conclude, because I've taken up 40 minutes, which was the plan. Some key takeaways. So financing SDGs is central to the mandate of DFIs. I don't know of a single DFI who would argue with that right now. It's taken a while, I think, for DFIs, national DFIs, to come to this, but there is a growing acceptance that actually has to be central. Secondly, it's critical that DFIs measure contribution to development impact. To understand and be reflective about your own impact, attribute your impact accurately, or at least more appropriately, and be able to report it to others, because others are looking. Consider the requirements to be considered, what it means to be mature with regard to SDG alignment. There are many clarifications and considerations there. Having a system, a monitoring system, which then allows the DFI to credibly measure and report the impact of your work. And so it's not good enough just to have a policy statement and a nice detail about what you want to do, but you need to be able to back it with the system. Have a results chain and a theory of change, which is well defined to understand the link between your activities, outputs, outcomes, and final impacts. And then recognizing that this is part and parcel. It's so fundamental to your strategy and the strategy implementation. So it must become embedded in the whole strategy process. So with that, I thank you, but I'm very happy to take questions, Prasad.
Thank you.
And I'll stop sharing my screen.
On the sharing, I believe there was a lot of information. I think there's a lot of details that we saw in that presentation earlier. I have a lot of questions as well, but before I rob the limelight, we already have a series of questions from our participants. Let's address them first. The first thing is, of course, Said Hisham asked a question in terms of funding. So perhaps this is based on your experience as well as looking at being a consultant to many of the national development banks. There is, in developing countries, funding for basic infra such as roads, internet, clean water, to go through, the people's daily lives. Are these considered as well as green funding scheme? Or part of SDGs, or are these actually count towards our sustainable development monitoring and measurements?
I think the answer to that is absolutely. That's a critical part. You'll find an SDG that you can hang your hat on around social infrastructure and economic infrastructure. And the infrastructure gap is so large and well recognized. So I think any infrastructure, DFI doing infrastructure can feel very confident that this is towards meeting the SDGs.
Mm-hmm. Great. Hope that answers the Said Hisam's question. In your view, how do DFIs can close its technical gaps in assessing viability of various complex green and sustainability projects? You mentioned about how projects will need to asking the client whether how many jobs were created is not it's not really, how you say, kosher on the surface of it. Right. So in your view, how do you think DFI can close its technical gaps in assessing the viability of various sustainability projects?
Well, I could be a bit cute and say, of course, that's what CENDB was set up to do, because we recognize I mean, it's a genuine statement. We recognize that the capacity gaps that may be in Malaysia, the few that may be here, also exist in Mexico, also exist in Nigeria, also exist in Indonesia. And the people who are doing that assessment, that technical assessment around how do you determine the viability of a green infrastructure project, and more importantly, do we take shortcuts, or do we accept a lower return because it's green? This is a conversation that is best had with your peers and facilitated. That's what we see about the Center of Excellence, is really being able to work through those challenges together. You can get training from, organizations that do specific sustainability training, but it won't give you that balance between the financial sustainability and development impacts that you're seeking to achieve. So I think that's hopefully a helpful answer. But these green projects, I think it was Michael who put up a slide. They're much more complex. It was way up in the right-hand corner. When he shares his slides, hopefully we can see it, and I'm not saying something nonsense, but I do believe that there's evidence to show that these are more complex, higher risk, because of often the technology is less developed and known.
Okay. There's a question from Ziza. Why is it, despite the campaign to support SDG, DFIs are still struggling to balance between gaining profit and achieving development goals? And some DFIs have to source their own fund, hence have to behave like commercial banks by giving financing to bankable or only viable projects. So perhaps you can take that one.
Oh, Aziza, I feel for you. I know exactly where your question's coming from. And I think this is the whole point around the need to communicate to government. You've given us a mandate. We are need to be a treasured instrument of government to deliver on your SDGs. You need to support us. Here is our development report. Here is what we've been, development impact report. Here's what we've been doing. Allow us to borrow internationally. Provide us your own funds. Guarantee, whatever. Let us get out there and fundraise with your support. Give us more capital.
Stakeholder management is very, very critical here.
Totally.
Okay, so the next question I have is from Encik Mohamad Hardi. What is the realistic time frame in your experience for DFIs to move from non-existent to mature stage in terms of the SDGs? You mentioned the step ladder.
Yes, the maturity ladder. Yeah, I think it's a good question, and I think it has everything to do with the policy commitment. If you've got a board that's really willing to buy into this, it would take 2 or 3 years to really get the hang of it, because it's a whole new system. You can imagine it's kind of the same, but more complicated than all of a sudden adopting an ESRM, a risk management, environmental and social risk management system. So it takes some time. We've seen our clients, within 3 years, they've got to at least advanced stage. Mature, I mean, I said there are very, very, very few organizations that are mature. KFW is mature. That's hardly, we can all aspire to a KFW, but they're in a small category of a few mature ones.
Okay, so the next question is by Puan Rosilawati Shahruddin. Hi Diana, can you share, based on your experience, how long is the journey for? Okay, so it's the same.
It's the same question.
Okay.
Yeah.
So, but the second part of the question is, what is the key success for those who actually, like you mentioned KFW or other examples? What is the key lesson or key success factors for those who have successfully done that?
Well, I would say you need the policy commitment. You need to have government on side. It's quite apart from getting more capital or whatever, financial support from them, but they need to see you as critical players at the table and be seeing you as partners in the delivery of SDG commitments. I think those two are fundamental to then having the sort of momentum to now get into this. Obviously, this is an investment, but it'll yield fantastic results because your whole staff will feel engaged. Your whole staff will feel, I used to think we were more of a commercial bank. I now get it. This is why I work here.
Right. It's the bigger why in life.
Exactly. The Simon Sinek, the why, ask the why. And it is the answer of why. Yes.
Okay, so we have a question here, which is similar between Anonymous as well as Noor Iana, right? So is there a difference between being sustainable and profitable? And if there is a difference, what is usually the ratio of sustainable initiative versus profitability in making analysis?
There is a difference. Sustainable is all encompassing. It's not just financial. It's leaving, it's, as I was quoting the Brundtland report, is leaving the future as good or better than your current situation. And so it's not just having financial viability, but it's doing no harm on the environment. In fact, helping the environment. It's about helping giving social benefit to the clients that you're supporting because they're able to create more jobs, because they're able to give access to infrastructure, much needed, et cetera. So that's the distinction or the similarity, but it's financial is within sustainable more generally, and it's understood that sustainability, obviously financial is a critical piece. I think the question is, what was the follow-up question to that?
The follow-up question was essentially, is there a ratio between where you balance sustainability and profitability?
Well, I think, that's a difficult one to say, whether there's a perfect ratio. You can imagine a credit committee who now is looking at the financial viability of the project in the credit analysis, and then the development impact, and is having to decide with limited capital, between a project that is going to generate a huge amount of profit, but either do no harm or potentially do harm. But, there's a trade-off there versus one that's not as financially attractive, but has huge benefits. I can't answer that question for any DFI, but that's a dilemma you're going to face, and you have to get to the bottom of your heart and determine what is important to you. Financial viability, I don't want to leave the impression that financial viability isn't important. It's critical. You've got to at least break even. You've got to pay your own way. The whole point of these institutions is not to be a drain on government.
Right.
But how much profit are you seeking? I think is the question.
Okay. So the next question I would like to hear from Noor Hakmarullah is, which FI should play a greater role in financing SDGs, commercial or development finance institutions? Your thoughts? Either DFI or commercials. Which one should pay more?
One of the best commercial banks is Standard Chartered. They have a great sustainability report. We're actually right now doing a study with 16 global export finance banks on sustainable export finance because they are pushing the export credit agencies. And if Malaysia Exim Bank is in the room, I'd love to talk to you on opening up the export finance industry to more generous terms. And so I see commercial banks being very active, but that's because they see the opportunities and they're being pushed by the borrowers. You can imagine sovereign borrowers saying we need better terms for hospitals because those aren't financially viable. So within the short time, tenors. So there's absolutely a pressure coming from there, but because clients want it. But I think both DFIs and commercial banks have a role, and DFIs have the responsibility to push it, I believe.
So Diana, we've got questions still coming.
Yes, and 7 minutes, I think. But I don't. Yeah, I'm open for as long. Yeah.
Okay, so I think everybody wants to engage with CENDB as well as Diana today. So let me just get to the question. The challenge in measuring sustainability impact is not only deciding on the indicators, but also the data availability used to measure the indicators. So if global data is used for domestic measurement, there is an issue of inaccuracy. What is your opinion as alternative to obtain better and more accurate data to measure sustainability impact?
Well, that's true. And my results chain, I talked about attribution. And what the key thing here is, it's around accuracy. So this is a really important point. So how do you measure impact? There are a variety of ways. You can do sampling. You can do, these impact assessments. A very sophisticated DFI would then have a independent evaluation unit that would be doing studies. I think the best thing you can do is try and find analogies, try and validate. So I didn't get into the detail about that of this, the quote of inaccuracy, but it's really around trying to find the best proxy and measurement for these impacts.
Okay.
And it's not good to just take global indicators. That doesn't work.
Understood. So there's a question from Mr. Iqbal Abdul Ghaffar. In your experience, how best can an SME focused DFI? This DFI is actually focused with building SMEs. How best can an SME focused DFI tap into the international market for funding relatively cheaply, or obtain grants for funding to develop the local ecosystem or achieve the developmental goals and mandate?
So when I hear you talk about developing the local ecosystem, it's really around capacity building of the SMEs and the infrastructure around them to be able to be bankable, so that the DFI can lend to them on a profitable basis.
Right.
There are many DFIs who look at different kinds of programs. I'm thinking one in Jamaica, for example, has the voucher program where they will fund through government money a technical assistance facility. So they'll receive the application and realize this SME really needs some help with business planning or marketing. And so we'll give them a voucher for training to be able to do that better. And then they become more bankable. It obviously, it is a grant program. Who can fund the grant? I mean, that's a question to government, but it's also, maybe out of your profits, there may be some contributions that can be made. But then you need to look at the international community. Who funds SMEs for capacity building, whether it's, UNDP, whether it's IFC may have programs, ADB, whoever. There are a variety of ISFD and the Islamic Development Bank. There's a variety of grant programs that could be available.
Okay. The next question. Given that SMEs run primarily on low-cost model, how important would the environment component be to an SME-focused DFI vis-a-vis social and governance components? So, perhaps I'll probably put this on context a little bit. Some of the DFIs in Malaysia actually focus on SMEs that are quite small in terms of in terms of their business itself. So they don't really have a specific department. Perhaps it would be a 5 to a 10-man show, right? Yes. So the question is, how important would the environment component be to an SME-focused DFI? So that would be the question.
If I think about how environmental and social risk management systems work in most DFIs, they categorize the type of project. If it's an infrastructure project, you pay more attention. If it's a manufacturing project, you pay attention. This gets into a low risk category. Most SMEs would fall into a low risk category. So it's sort of a quick categorization, and then know what kind of due diligence and recognizing environment is. You might ask them for, a few questions about how they treat something. Depends on what business they're in, but it's really low touch assessment.
Okay, so in other words, even for the for measuring so ESG for micro enterprises, you could probably have a soft touch kind of
Yes.
monitoring for them.
Yeah.
Okay, so that would still have a big impact to the organization because you're still monitoring ESG throughout your entire spread of customers.
Well, you might ask them, 4 or 5 questions up front and then realize there's nothing to worry about. And that's no longer part of the assessment. I think common sense needs to prevail. Develop a system that catches 90% of your business and then apply common sense.
Okay, so there's another question here. The SDG requires long-term commitment and contribution from whole. How does the current pandemic affect the SDG objective activity systems around the world? Now, I think this is a very relevant question.
Well, it is. I don't see the UN changing the SDGs, and the goals are still what they are. And 2030 is still, 9 years away, but not really. It's going to come very quickly. So, I don't know specifically how to answer that, but I don't think we should let ourselves get off the hook as a world.
So, a follow-up question to that is: are we actually, have we been in any way delayed in terms of reaching it, or were we delayed before even the pandemic?
I think the latter is true. In many countries, maybe not Malaysia. I don't know how well you're doing against your SDG commitments, but in other countries, it's going to be a scramble. It's a big challenge to implement. And it's because the financing just isn't there. The will is there, but the financing isn't there.
I see. Okay. So next question is, there's a lot of questions for you, Dana, today.
I know.
So there are commercial banks that gives the borrower interest rebate based on completion of milestones of the green project. Is this the way forward? What is your view on this?
Yes, it is. Yes. The rebate, the discount has to be carefully calibrated, but incentives are critical.
Mm-hmm. Okay, great. So 2 more questions. I think you're very popular today, Diana. So how do we verify the impact created at DFI level besides getting the info from the customer?
I think I touched on that answer or that question a little earlier around the surveying and sampling to bring validation. So it's a bigger research project, but there's nothing like getting on your feet, walking into a customer's business and really seeing it with your own eyes as well. That's something that I believe very strongly in and encourage DFIs to do that. Spot checks.
Fantastic. Okay, so this is the final question for tonight. What happens if the numbers obtained during origination differs during the monitoring period?
Well, this is why you don't report origination numbers. You report monitored numbers.
Right.
And all the will in the world, you can hope to have, made 15 hires if you're an SME. But if it doesn't happen, you shouldn't be penalized, but the DFI shouldn't be reporting the full number. So it happens, and it's the way business goes.
And of course, whenever we report those numbers, even to our management, the first question is that why is there a difference, right?
Yes. Well, exactly. So you live and learn.
Okay, so that is all our questions for Diana today. We sincerely appreciate Diana for spending her time and her sharing with us this morning here. And we also appreciate the fact that it's nighttime there. In
got dark around me.
Yeah, it got darker. I noticed it got darker. So we really thank you. And Adfim we will be continuing our working relationship and cooperation with CENDB. And if any of the DFIs would like to engage with the CENDB, just let me know, and we will arrange a session with Diana as well. Now, moving forward, thank you very much, Diana.
My pleasure.
Applause for you. Thank you very much. And ladies and gentlemen, participants, as you may already know, long hours of sitting and exposure to screen time may cause fatigue. So I do know that you've been sitting with us. 300 over participants have been sitting with us since 8:30 actually, 8:30 a.m. until 12 p.m. right now. So we will take quite a long break. We'll take a 2-hour break from 12 p.m. until 2 p.m. And at 2 p.m. we will be joined by our experts from auctusESG, and then followed by the Turkey Industrial Bank. Right, so we have a lot more sharing going on at the second half of the day. Right, in the meantime, if you do wish to leave Zoom, you can leave Zoom, and you can enter using the same link that has been provided. Otherwise, you can just stay in Zoom and just come back at 2 p.m. The choice is yours. Right, so we will take 2 hours break for us to have lunch, refresh ourselves, and rest. We will return at 2 p.m. Malaysian time for 2 more speakers. See you in 2 hours. Take care. Thank you, Diana. Take care.
Always have a support structure that you can rely on, having people that can always deliver, and at the very least, those that can show progress on a daily basis.
Kita adalah brand holder. Kita kena yakin dengan brand kita. So sebelum kita nak meyakinkan orang dengan brand kita kena yakinkan diri kita dahulu. So macam mana? Ilmu, knowledge. Pergi belajar. Tak belajar, tak tahu. Saya buka syarikat saya sendiri sebab masa itu saya yakin masyarakat tak boleh bergerak tanpa motivasi.
புதுசாக வித்தியாசமாக நீங்கள் யோசித்து ஒரு மார்க்கெட்டில் டிமாண்டாக இருக்கிற ப்ராடக்ட்டை நீங்கள் கொண்டு வந்தீங்கன்னா பயணியராகவும் ஆகலாம். அதே சமயத்தில் மக்கள் திருப்பி வந்து உங்கள்கிட்ட வாங்கிட்டு இருப்பாங்க.
把你的生意放上网络平台，我朋友是做网络卖衣服的生意，他的生意是不断的在增长。我起步的时候是跟去银行贷款，所以他说我的规模也是太小，所以他是不接受我的贷款的。有一天我上网寻找贷款，等下过后就找到 SME， 过后我去 click 进去申请表格。第二天 CGC 的有一个顾问打来跟我说，你可以尝试用 P2P 的平台，过后就成功了。
The great thing about this whole CGC ISME program is that it's no collateral, and you can go for as little as 1,000 ringgit to as much as 5 million. I went online and went to the page, registered, logged in, and just keyed in my details. And from there, within a matter of days, things were already set in motion. So it's really that straightforward and that simple. I was able to get it within a matter of weeks. I think everyone can too.
IMSME ஃபண்ட் வந்து நாங்கள் வந்து அப்ளை பண்ணியிருந்தோம். எங்களுக்கு கிடச்சிச்சு. அது மூலிமா எங்கள் பிஸ்னஸையும் வந்து எக்ஸ்பெண்ட் பண்ணோம். 10% வந்து இன்க்ரீஸ் பண்ணோம் எங்கள் சேல்ஸை. இது மூலிமா IMSME ஃபண்ட் வந்து ரொம்ப உதவியாக இருந்துச்சு எங்களுக்கு.
Sebenarnya dalam business, fun is everything. You have fun, you can go bigger. You don't have fun, you cannot go anywhere. CGC banyak membantu saya untuk saya go and move further sebenarnya. Dan at the end, saya dah ada branch baru dekat Alustah selepas saya dapat dana daripada CGC. I have no fun problem at all after that. Jadi dengan IMSME memang banyak